What's up, everybody? Hope you guys are having a great day. I figured today what we're going to talk about is how confluence has an impact on your trading and on your investing and what you do. And the confluence that we're going to talk about today is through the use of Fibonacci. Some of you are familiar with Fibonacci. Some of you may have already got the concept down, but I want to at least talk about utilizing Fibonacci's with confluence so that it can maybe help improve your probabilities of success, whether it's short-term trading or long-term trading or whatever it is that you do. Now, if you do use Fibs, do me a favor. Use the comment section down below. Tell me how you use them. Tell me what you look for. Tell me some of the things that you do and how you have found them. And I'll tell you a little bit about what I use them for and how we identify opportunities with them. Now, if you're new to the channel, do me a favor. Click the subscribe button. Hit the notification bell. So you get the alerts and the updates, and hit that thumbs up. That really means a lot to the computer. But before further ado, let's take a look at the value of confluence in the overall market. So when we talk about the power of confluence, what we're specifically speaking to are Fibonacci numbers. And Fibonacci numbers come from an Italian mathematician, and he wasn't just good at counting pasta, but he was good at everything to do with understanding how numbers relate to one another. And the Fibonacci sequence is nothing more than the sum of two numbers that precede it, right? So 0 plus 1 equals 1. 1 plus 1 equals 2. 1 plus 2 equals 3. 2 plus 3 equals 5. 5 plus 3 equals 8. 8 plus 5 equals 13, and so on and so on and so on and so forth into perpetuum, right? And so what this leads to, this Fibonacci sequence, if you start dividing numbers in the sequence, it leads to Fibonacci ratios, right? And Fibonacci ratios. And so, for example, if I take 34 divided by 55, if I take any number and divide it by the next number, I'm going to get 0.618. 0.618. Anywhere in the ratio, anywhere in the sequence, that's the ratio that I'm going to get. And so you'll hear people talk about the 61.8% fib number, and it's 0.618. It's taking the number and divided by the next one. If I take any number and divide it by two numbers in front of it, 34 divided by 89 would give me 0.382, right? So 38.2% fib is what you'll hear people oftentimes say, but 0.382. 34 divided by 144, so if I take a number and divide it into the number 3 in front of it, it would be 34 divided by 144 would give me 0.236. And so these are very common fib ratios. And then if I take any number and divide it by the number that immediately preceded it, I get 1.618. And so these are the most common fib numbers that are utilized. Now, there's a few more that are added. The square root of 0.618 is 0.786. So you do see 0.786 used quite frequently. And then you also see 50% as a fib number. Although 50% is not a Fibonacci retracement, it is a fib number nonetheless, is what people use, right? So when I look at a line segment, that line segment is typically broken up into Fibonacci retracements, and you'll see that 0.236, 0.382, 0.5, 0.618, 0.786 expressed as percentages, right? So essentially what we're saying is that 23.6% of the line segment is that upper part. Now, oftentimes we'll see markets retrace back to key Fibonacci areas before then bouncing and going higher. Now, why does this work? Well, this works because enough computers and enough algorithms use it to make it work. If there's not enough computers and enough algorithms using this, then it becomes a really useless endeavor, right? So here's a small time frame stock chart, and we're going to go to a larger time frame one here in a few minutes and look at what is the S&P doing when it comes to Fibonacci's. But here's a small time frame chart, and in this small time frame chart, we're taking the lowest low on this chart and the highest high, and this is the lowest low and the highest high over the last 20 days. And so in there, you can see that there are common turning points at some areas at Fibonacci retracements. And with those common areas and common turning points, we see that the market tends to move and change directions. Now, and so this is the simplest way to use Fibs, is to find a line segment, draw a line, and find some of the separations that exist. Or I could draw my line down here and just take one trend. And so the biggest question with Fibs becomes, where do I start and where do I end my lines? And that really is the subjectivity that exists in Fibonacci ratios, because you can start and end your lines is going to make a very different outlook on what it is you're trading. And so whether I start my line at the top, whether I start my line at the bottom, or whether I use the entire segment is going to dictate where those Fibonacci numbers are. So what's the best way to do it? Well, the best way to do it is to utilize what's confluence. Now, here's a picture of the city of Pittsburgh, Pennsylvania, my hometown. And this is the confluence of the Allegheny and Monongahela rivers. If anybody's ever been to Pittsburgh, Pennsylvania in the United States, this would be one of the most beautiful cities in the country. I love this city. But you can see one river down there on the bottom, and it's got a nice brown color to it. And one river up on the top, it's a little bit nicer color, blue or green, whatever you want to call it. And where those two come together is the confluence. And a confluence is the coming together of two things to make one greater thing, right? And in this case, the Allegheny and Monongahela rivers come together to form the Ohio River, which is a much greater river. Now, by the way, that comes together later on to form the Mississippi River. And so larger rivers are formed by the confluence of smaller rivers. So if I think about the confluence of rivers, when I think about my Fibonacci ratios, we're going to use the confluence of multiple Fibonacci numbers. Now, how do I do that? Well, let's take one line segment. And this one line segment, we're taking the most recent, strongest trend. Now we can see that our Fibonacci numbers are associated there. And then we take another trend, a bigger one, and we see another area of Fibonacci. This is where the red overlaps with the black. And notice where the red and the black overlap become very strong turning point areas. Here we see the 50% and the 61.8. Above there you see the 38.2 and the 50%. Where those overlap together then become powerful potential trading points. So now the trading point itself is not going to be dictated by the Fibonacci. The Fibonacci are simply going to help to enhance the probability of those trading points. So in this case, we have a fair price value area, old area of resistance, acting as a new level of support, the origin of a strong rally in price. And what we're doing is we're combining that fair value area with the confluence of multiple Fibonacci's, and it's the identification of true levels that make that zone a quality zone. If you look back, we have a confluence a little higher at the 38.2 and the 50% area, but that 38.2 and 50% area is not as quality of a confluence because it doesn't line up with a quality area of demand. In this case, we line up with a quality demand area and a quality fair price value area in order to create a true area of confluence. And that, in my mind, is the best way to utilize Fibonacci ratios in your trading. Now, what does it mean for today's market? So here we have a chart of the S&P 500 on a weekly chart. And what we mean by a weekly chart is that every candlestick represents a week. Now, if I were simply to draw my Fibonacci's from the low to the high, now what we're using here are the lows from COVID in 2020 to the all-time high. And I have my Fibonacci's set to only show the 0 and the 100% because this is how I oftentimes will identify my zones. But I'm going to add in my Fibonacci lines, and I'm going to make all of these black in where they are, and I'm going to increase their thickness by just a bit. And so I'm going to make all of these black and increase their thickness. We can see, well, we have a 50% area in through here. And let me turn on the showing the coefficients. Okay, so we can see the 50% area, the 38.2, the 23.6, and notice that the market has turned a little bit at each of those levels in some way. So this would be utilizing the most recent big low to the most recent all-time high, a very reasonable place to draw our fib lines. And so the reason fib lines work, by the way, is because so many other people use them. So you want to use very common areas. Well, what would be the last very big market bottom that people were going to pay attention to? And in my mind, you really want to go back and look at the 2008 market bottom. Now, why do I go back to the 2008 market bottom? Well, because this was our most significant drop in the market, and it started a new bull run. I could certainly take some of the other lows, but for example, this 2018 low was taken out by the COVID lows. And so I had no real other pullbacks to lean on. So going all the way back to the 2008 market lows, when I pull from 66 all the way up to the high, now I'm going to create my confluence zone. And when I create my confluence zone in here, I'm going to see, are there any strong overlaps in the 2008 lows versus the COVID lows relative to our all-time high? And so this is where I'm going to pay particular attention. So thicken these lines up a little bit, show my coefficients on the left, and I hit OK. Now, what do we see when I look at this? Well, in my mind, the clearest and most obvious, I've got two very strong numbers that correlate over top of one another. If you notice, I mean, they're ridiculously correlated when it comes to some of these numbers, but specifically the 61.8, the 38.2. I mean, they are very, very closely correlated. They almost overlap each other perfectly, and that's because the 100% low started at the 61.8, essentially the 61.8 retracement of this big move. Now, at the time, this wasn't a 61.8% retracement of the big move. And so what we're looking at it is in a bit of retrospect. And so going forward, my eyes immediately are drawn to these two levels here, the 61.8 here and the 78.6 right through here as potential market turning points. And so now if I zoom in and go in a little bit closer, do one of those have a quality area of demand, a fair price value area that I can lean on? Well, if I look at this and I look at this from a fair price value area perspective, I'm going to pay specific attention to the fact that we had an area of resistance up here that was broken through, but then we kind of created a bit of a demand zone right in there. And so that demand zone that was created right in there now gives me this area as a potential bounce point going forward. And so the line that I would draw here, and I'm going to go and get rid of the Fibonacci numbers just so that we can clean up our chart a little bit because I've done a bit of analysis. Now, as I look at this zone, I see that 3,500 by 3,206 would be my area where I've got your highest probability of turning. And 3,206 down here, this is a pretty wide area. So the number that I'm really looking at is 3,250. So the 3,250 number in my mind is about the area where we see the first cleanest level of confluence for a potential turning point in the market. Now, I'm not saying that's going to be a bottom in the market. I will certainly not be willing to take any sort of long trade until I get, let's say that I get a red candle that comes into here. And then let's say I get another red candle somewhere in here. All right, I get two red candles just like this. Doesn't mean that I'm going to be willing to, it doesn't mean that I'm going to be willing to go to get long on that position. What it will mean is that at that level, now I'll start to look for some sort of a reversal pattern, right? Maybe I get something like a dragonfly doji in this area, right? And if I get a dragonfly doji in this area, I would look for a long above that candlestick's high, right? And if I get a long above that candlestick's high, my stop's going to go below the low of that candlestick, which means that I can take opportunities for long entries with very small exposure and risk. And that is how you get back into a big move up very early in. Now, if you're doing this properly, you're probably going to get stopped out a few times on your way back up. And so what we want to do is control our risk and protect ourselves. So hopefully this makes sense to everybody. Leave a comment down below on any thoughts that you might have on this. We really want to hear from you. But until next time, everybody, hope you guys have a great day. I will talk to you soon. See ya.